Good afternoon and good morning and good evening to all our audience from different parts of the world. Today I'm going to do a presentation on common mistakes in machinery and equipment valuation. So throughout the webinar, I'm going to focus on 7 items that will be part of the webinar. And I'll look at introduction, the aims of this webinar, professional valuation standards and regulations, categories of mistakes, common mistakes that we find in the valuation, machine equipment valuation reports, and then common mistakes pertaining the IVS 300 plant and equipment, that is the asset standard that we are expected to comply with, and then closing remarks as well. So I'll start with a simple quote that I got, which reads: mistakes are costly and somebody must pay. Time to correct a mistake is before it is made. The causes of mistakes are: first, I did not know. Second, I didn't think. Third, I didn't care. This is by Henry H. Buckley. Then our aims of this webinar today is to expose and explore the errors commonly found in valuation reports and provide suggestions or guidance on how to author an effective report. And also, the aim of this webinar is to remind machine equipment valuers about the objective of carrying out a valuation and presenting a report. The purpose of presenting the report is to effectively convey the information necessary for proper and clear understanding of the valuation. What we are doing is we are presenting what we have done to the clients and the intended users as well. So the most important thing when you are identifying or when you are preparing a machine equipment valuation report or carrying out an assignment, you need to comply to professional standards and regulations, right? My focus will be on Saudi Arabia and Nigeria. So international valuation standards, they apply to both Saudi Arabia and Nigeria. And in Saudi Arabia, we focus on Taqiim Code of Ethics and Conduct for Valuation Profession. It's a requirement, and there are certain requirements that we are expected to comply with in this regulation. And in Nigeria, there's a Nigerian valuation standards, which is called the Green Book. I believe most of us, we use that one for in our day-to-day practice. And then we have got the Nigerian Code of Ethics and Conduct for Valuation Profession as well. So these are the tools or documents that we need to comply with as we are doing machine equipment valuation in our respective countries. So how do we get to know the mistakes, or how are the mistakes in all these reports identified? Most of them, they are identified through report reviews. Report reviews, when you present your report to your clients, Sometimes a client, when he's more knowledgeable about valuation, he can go through the report, or he can pass it on to experts. Maybe it is for litigation. So lawyers are going to review so that they can fully understand the contents. Like what I said, the purpose of valuation, of presenting a report, is to present what we have done, not what is expected, but, or not to come up with a colorful document. But a report should serve the purpose. The purpose of the report is to communicate effectively with the clients, to say what you have done, how you have done, how you have come up with the valuation results. So you find they can give it to the intended user. If it is for financial reporting, they will give it to the intended users as well. Sometimes peers can help us to identify mistakes. Peers within your organization or your fellow machine equipment valuers can review your report and identify some irregularities that are in the report. And there are valuation reviewers as well. Most of them, they are trained and accredited. These ones, they are assigned to review reports. Like for us, Taqiim, at Taqiim, we review most of our reports done by our members. We review them to identify if they are in compliance with our regulations and standards, evaluation standards as well. And then we have got auditors. Auditors as well, especially if you have done valuation for financial reporting. They will review the reports that you have done for their clients, the firm that you have done the valuation for. They will review the reports to ensure that it is compliant with their requirements. The requirements for them to be able to use it for auditing, and if the results are reliable. So there are certain things that they look in the report, particularly the compliance in terms of the valuation standards, and as well as the financial reporting standards as well, particularly when you are doing valuation for financial reporting. You are expected to comply with the requirements of IFRS 13, fair value. So this, they will make sure that all the requirements of IFRS 13, they are fulfilled. So that's how they do the review and identify if your report is reliable and credible as well. So there are some categories of mistakes, because when someone who is trained to do review of reports, they will look at different categories, or they will come from different angles of reviewing the report. So the first mistakes, they emanate from failure to comply with IVS standards, or local valuation standards. Like in the case of Nigeria, the Green Book, are you in compliance with the Green Book valuation standards, as well as the Code of Ethics and Conduct for valuation profession as well? So that is the first category of mistakes, and we'll be looking at some of them as we will go down the webinar. And then we've got a second category, mistakes related to the reasonableness of the valuation conclusions. Are the conclusions reasonable? Are they reliable? Are they relevant to the purpose of the valuation? Those are some of the things that they will look. Mistakes can be identified in line with the reasonableness of the valuation conclusion. And then we have got mistakes. The last part, the mistakes associated with the writing and presentation of the evaluation processes undertaken for the evaluation assignment. That particular assignment, you are reporting on the processes, the evaluation processes that you have used, the evaluation processes that you have undertaken, that you have gone through, the processes that you have gone through. So that is what we are communicating. The report is made for the client, not for us. No matter how colorful and how flowery you are going to present, but it should serve its purpose to communicate your evaluation results, your conclusions, how you have done the report. So some mistakes can be identified if you did not follow through what is required. So categories of, here now we are going to look at some of the mistakes that you find in the report. The first one is the details of the client are not fully presented in the report. This is one of the issues that you find. And this is, if you fail not to present or state clearly the details about your clients, it means the report is not acceptable, because in terms of IVS 101, which deals with the scope of work, it is one of the requirements that you should show the details of the client. Who is the client? What does he do? And this is the client who has requested for the valuation. So the report is going to be addressed as well to the client. So the report must confirm the person for whom the valuation is being performed. The person or persons. It can be a company, it can be an individual. So you need to state who requested for the valuation. Why are you doing that report? To whom are you reporting that report? Are you preparing that report? So that is very, very important. You will be in compliance if you follow this, if you provide details. But if you don't provide details, you are not in compliance with the IVS 101, something to do with scope of work, and 103, which is reporting standards. So you need to follow those standards. It is also important to note that the evaluation is expected to meet the needs. So if you don't know, if you don't tell us who the valuer is, the client is, so how are you going to know the needs of the client? Because every client has needs or her specific needs. So hence the report must provide the full details of the client or clients. Another mistake is that of the report does not mention the intended users. I've, through my experience and as an evaluation reviewer, I've come across a lot of evaluation reports where the intended user is not specified. They don't even mention about the intended user. Maybe the report is going to the bank, but the name of the bank is not mentioned. It might be the finance house, or it is for insurance purposes. The name of the insurer is not mentioned, but the report is done for valuation. Who is going to use that? They don't mention the intended user. So you need to mention for the report to be acceptable, for your report to be credible, for your report to be proper and reliable as well. So the identities of the user and even the clients, like what we have said in the first place, they need to be mentioned, and their requirements as well. Because if you are doing for insurance purposes, they have their own reporting requirements that they need you to provide. Every valuation is different. Every valuation is unique. Even if you are doing it for insurance, it's not the same. Even if you are doing for a lending institution, it's not the same. They are different. They have different requirements, depending as well with the type of machine equipment that you are valuing as well. So it is important to give the identity of the users and their requirements. If it is for financial reporting, the intended users are the client as well as the auditors. You have to mention the auditors. Who are the auditors? Who are going to use? Because the report is directed to the intended user and the client at the same time. But in some instances, the client can be the intended user as well. So this must be clearly stated in the report. So it's a requirement that you should follow the expected required standard as well. And then we've got the scope of work. There are certain mistakes relating to the scope of work. That is the report contains vague terms of reference or terms of agreement or the scope of work that you provide. So the terms of reference must be clear right from the start. They must be very clear and they must be relevant. I've seen in instances where people, they've got a template which they say, which fits every client, but that is not the case. Every term of reference should be different, depending on the purpose, depending on the client, and depending on the requirements. So the scope and the limitation of the evaluation are sometimes not clearly or sufficiently outlined in the report. So that discredits your report if you don't show the scope and the limitation of the evaluation. The scope of work in the report is important in that it confirms the valuer's understanding of the needs of the client and the intended users. That's why the scope of work should be stated. The terms of reference should be stated in the report, so that people or whoever is going to read or whoever is going to review can have an understanding of the needs, can see that you as a valuer, you really know or understand the needs of your clients and the intended users. All the fundamental terms of the evaluation must be contained in the scope of work section of the report. So that section, scope of work, must be found in every credible, properly done report as well. Then valuation reports does not refer to the current IVS standards or national valuation standards and regulations as well. This is a serious mistake because every valuation report should comply to the latest or the current IVS standards. Right now, our current IVS standard that we are using is the IVS 2022. That is the one that we are using, and we are almost coming to the end. By next year, we have 2024, IVS 2024, but currently we are using IVS 2022. So it is, you are expected to comply with that. If you don't mention the reference to that, I have seen some reports where there is no mention of the standard that has been used. It's just a report. It's just mentioning the assets that have been valued, no reference to any either local standard or the international valuation standards and regulation. That is not acceptable. But unless there is a reason for departure, the reports must not refer to USPAP or use terms and definitions from USPAP in Saudi Arabia and Nigeria, because Nigeria and Saudi Arabia we have adopted IVS standards as the basis of our valuations. So USPAP is specifically for the United States and Americas, where they use that kind of standard. So it doesn't apply in Saudi Arabia and Nigeria. So by using that, or by mentioning, or by taking some of the references from the USPAP, it will sort of like conflict with some of the requirements. But if you are departing, maybe you are doing the valuation for your client who is going to use it in the United States of America, then you need to mention in the report so that whoever is going to review the report or whoever is going to use the report can understand where you are coming from. The valuer is not required to refer to old IVS version for current valuation assignments. The old IVS version may be used in case when a valuer is required to carry out a valuation assignment in retrospective date, when the old IVS version was effective. Maybe you are doing a retrospective valuation where you are referring to maybe it's 2020, let's say 2018. You can refer to IVS 2017, right? You can refer to IVS 2017 because that is the period where that IVS was effective. So you can make use of that. But if you are doing a current valuation, right? Like today, you are doing a valuation today, you need to use the current IVS. So we have seen people who have an old IVS standards or version that they have, and they did not follow up on the latest. They are not updated with what is happening. So they always stick to the old IVS, which is no longer effective. So that is a serious mistake that can affect the valuation as well. And your report won't be reliable because it is still working on the old IVS. So because IVS 2017 and IVS 2022, they are different. They are totally different. They are things that are in 2022 IVS that are no longer relevant that way, that you won't find in the IVS 2017 as well. So this must be explicitly disclosed in the report. For new valuations, the current and effective version of the IVS must be used. Right. Another mistake is the report does not clearly state the purpose of valuation. The report does not clearly state the purpose of the valuation. For example, it is not proper to state that the purpose of this valuation is to provide an opinion of fair value or market value of the subject assets. This statement looks good in the eyes of an ordinary person, but technically it is faulty right? Technically, it is not correct. Because if you say you are going to provide an opinion of fair value, right? Or a market value, what do you mean? What is the purpose of the report? What is the intended use of the report? That's what we are saying. So when you are doing a report, it's best to ask your client, probe your client, and say, what exactly do you want the market values? Because sometimes clients, I've seen clients coming to me and say, I want market values. Can you just give me market values? I want market values. Can you do me evaluation? I want market values. You have to ask, what is the purpose? What is the purpose of those market values that you want? What are you going to use the report for? So you need to know the purpose. Is he going to sell? Is he going to take a loan from the bank, right? A secured lending. For secured lending, is it for insurance or whatever he wants to do? So you need to fully understand the purpose. So by writing to provide an opinion of value, of fair value, that is not proper because it's not clear. Nobody knows what is the use. So we want to know the use of the valuation. A proper valuation report should state clearly the purpose of the valuation. It is crucial that the purpose of valuation is clearly identified to avoid situations where the valuation conclusions and advice are not used out of context or for purposes for which they are not intended. You see, if you say you are just going to give market value, anyone can use it for any purpose. You can use it for disposal, you can use it for getting a loan, you can use it for a number of purposes. So you need to be very specific. That will ensure that your report is reliable, your report is proper, your report is relevant, and your report is credible. That is the most important thing that we want to get from you. And then another common mistake is the report does not have a proper basis of value related to the purpose of valuation. The report doesn't have a proper basis of value. Mostly, the purpose of value relates to the basis of value, right? It relates to the purpose of value. So you need to make sure that the purpose, the basis of value relates to the purpose of valuation, to the purpose of valuation. Fair market value is not an IVS basis of value. I hope I'm not creating a debate here, but this is correct. The fair market value is not an IVS basis of value. However, the IVS provides an explanation of situations in which it may be used, right? Where it may be used. Like there is one definition that you can find in the IVS, but it's a non-IVS basis of value, which is fair market value according to OECD, Organization for Economic Cooperation and Development. It's an organization. If you are doing valuation for that organization, OECD, then you can refer to the fair market value only. But if you are in Saudi Arabia doing evaluation, you need to use IVS basis of values. You need to use IVS basis of values. And if you are in America, you can use, if you are doing valuation for US Internal Revenue Services, yes, they want fair market values. These ones are use per terms that we are talking about. The fair market value is a use per term. It specifically work within a jurisdiction like the United States of America. That's when you can use that. But Taqiim and Nigeria, it's invasive, right? They have recognized the basis of values stated and defined in the current IVS and their national valuation standard, like the green book. It talks about the basis. It has adopted the IVS basis of value, right? So those are the ones that we follow. Those are the ones that we follow, right? Then we've got terms such as going concern value, right? GCV, are not defined in the IVS glossary. As a result, it is not proper to use the terms in the machine equipment valuation reports. We don't say, I'm going to give you going concern values of machines and equipment. No, they don't. It doesn't work. It is not proper. The term going concern value is only recognized in business valuation, right? Those who are in business valuation, you hear them talking about going concern values. It goes with that discipline. But in machine equipment valuation sector, we don't use going concern value. So that term should specifically be used in the business valuation, right? So another important thing when we are talking of the basis of value, you need to define it and cite the source of the basis of valuation, the source of the basis of valuation. If you are using market value, where did you get that market value, right? You need to state where did you get that basis of market value. Where did you get the definition? Where did you get the definition of market value? You need to state that in your report. Don't just say the basis of value is market value and you define market value, right? The definition is correct, everything is okay, but you did not cite where you got that definition. So if you need to state where exactly did you get that. Normally you find it in IVS 105, basis of value. So you need to state that's where you have extracted that definition. You need, if it is IFRS 13 fair value, you need to state where did you get that basis of value. It's very, very important. And it's a requirement, it is our expectation that when you have finished the report, whoever is going to review your report must understand and must know where you took that definition of the basis of value that you have used. Another mistake that we find when people are doing machine equipment valuation as well, the report not stating the premise of value, not stating the premise of value. For example, the report with the cell, right, as the purpose of valuation is not specifying whether the opinion of value to be provided is either in situ or ex situ premise, right? You need to really specify. If someone is selling his equipment and he approaches you, say, can you do the valuation of my oil refinery or of my brick making plant? You as a valuer, you say, okay, I'm going to give you market values, that's fine. But the market value should have a premise. Is it going to be in situ or is it going to be ex situ? When we are saying, is it in situ, we mean to say, are you going to, is the plant going to be sold where it is, right? Where it is and to be used where it is. In other words, the person who is going to buy either is going to list the premises where the machine is, or is going to buy the machine and the land and the property as well, so that you can continue operating. Or in some instances, when it is ex situ, it means the person who is going to buy the plant is going to decommission it, is going to dismantle it, put it in containers, transport it to the new place where he's going to reinstall it. So all these things, they need to be considered, because these are factors that can affect the opinion of value that you are going to give at the end of the day. So you find if it is an evaluation for sale, right, and you are giving the market value as the basis of value, then if it is in situ, the market value is going to be different from that of ex situ. So we need to take note of that. Every time when you are doing evaluation, you need to know what are the premises. Sometimes it's the highest and the best use that you are talking about. You need to consider that. Highest and best use as well. It's one of the things that you need to consider. Sometimes it's in order liquidation values that we are providing, right? So the liquidation value should be orderly, right? So orderly sell, orderly disposal. That is the premise of value when you are talking about liquidation value. You don't say I'm going to provide liquidation values. Which liquidation values are you talking about? Is it an orderly liquidation value, or is it a forced liquidation value that we are talking about? So all those things, they must be found in the report. They must be used when you are doing the valuation. Otherwise, at the end of the day, what you have is not proper. At the end of the day, what you have will not be proper as well. It is important to note that the value of most plants and equipment is exceptionally sensitive to different premises of value. Like what I've said, the market value in situ and market value ex situ, there are two different values market values that you are going to derive. So you need to consider the premise of value, because it really affects your valuation conclusions at the end of the day. Another mistake that we'll talk about as well is the valuation report does not clearly state the reporting requirements of the basis of value and the purpose of the valuation. For example, a report for bank lending purposes, does not provide any reporting requirements for the concerned financial institution. This is not proper. It's a serious mistake, because every financial institution, it has its own reporting requirements depending upon the type of machine that you are valuing, the assets that you are valuing. They can determine the reporting requirements. So my advice is, when you are faced with such kind of situation, what you need to do is to approach the financial institution. Ask your client, who is the financial institution, right? Who is going to use the report? Who is the intended user? That's why it is important to know the intended users, so that you can engage them right from the start of the report, of the valuation exercise. If you don't do that, what is going to happen is you are going to come up with the wrong or inappropriate valuation conclusions, and you are going to revisit again the report in order for you to meet their reporting requirements. So a prudent valuer, first of all, he has to engage the intended user, which is in this case the financial institution. Approach them, find out what are they looking for, what are the reporting requirements, what are their expectations, what are their expectations as far as the valuation is concerned that we are tasked to do. So if it is in the case of insurance as well, let me look at insurance. I've seen people who are saying they are doing evaluation for insurance, and you look at the report, they don't state who is the insurer, the insurance company. There are no details of the insurance company. Honestly, that report can be used by anyone. You can take it to anywhere. But if you take it to some of the insurance companies, they will refuse because their reporting requirements doesn't meet their reporting requirements. So you are bound to go back on your desk and start to redo the report. So you are doing one task twice. So consider the time and as well as the embarrassment that you get when you are doing the report, redoing, right, the report. So the most important thing, if you are doing for financial reporting purposes, find out who is the insurer. Look for the insurance policy, the terms and the condition of the policy. That is very important. You need to know that. It's very critical for you to fulfill. So that is what we are saying here. Most reports or some of the reports do not clearly state the reporting requirements, right, of the institution that they are preparing the report for, right? It is important to note that evaluation report must be prepared as required by the client and intended users. It's not for you. Remember, the evaluation is not for you, right? So don't dictate to the client what the report should be like. You need to sit down with the client, agree on the requirements, right? Advise when they are in doubt, and then write it down. That becomes the scope of work. That becomes the scope of work. Then it shows that we have fully understood the requirements of your client. We don't want to see you in a situation where someone would say, I can't understand what you're trying to do here. It shows you haven't done your work. You did not do your work properly. So you have to do the right thing at the first instance. Another mistake is the report does not provide clear and relevant assumptions and limitations. Most of reports are found short of this. It's a very common mistake where you find they are generic. You find they are generic assumptions, right? Some reports, they contain those. They are generic assumptions extracted from other reports or template reports, which are not relevant to the valuation reported. We have seen that happening where most evaluators, maybe it's because of time, but you need to properly use your time, right? There is no need for you to rush and come up with a half-baked thing that you'll be asked to go back and redo. So the best important thing that you need to do is to come up with assumptions that are relevant for the valuation you are doing. So avoid using generic assumptions because people have got templates. What they do is after finishing the report, the calculations, they just go to the templates, change names and all those things, but assumptions, they don't look at the assumptions. Because when you come across particularly auditors, they sometimes give you a running for your money. So sometimes they give you hard times. Why? Because you have provided generic assumptions. So they are aware of that. So they try to see if the assumptions are relevant. And then you are found short of that. And the report must clearly state all forms of material assumptions made in the carrying out and reporting of the valuation. All the important assumptions, they must be stated properly. For example, assumptions to do with the condition of the asset. Come up with assumptions to do with the condition of the asset. Assumptions to do with the extent of extent and limitations of the inspection. Did you do the proper inspection? What kind of inspection have you done? Did you face any challenges? What have you done to overcome that? Regulatory compliance as well. You can come up with assumptions relating that. assumed profitability as well. Those are some of the assumptions. You can come up with some assumptions relating to that. Excluded assets. What are the assumptions that we have done concerning the excluded assets? Reliance on third-party data. Did you consider that as an assumption when it comes to reliance on the third-party data as well? The report must clearly state all forms of material assumptions made in the carrying out and reporting of the evaluation exercise. So we should do away with the use of templates where we take generic assumptions, or sometimes we just copy the assumptions and put them in the new report. Make sure you relate, you try and review them before you move on. So another assumption is, another mistake is that of the report does not indicate the market period that might be required to dispose of the asset. This mistake is prevalent in reports prepared for sale and liquidation purposes. You know, when you are doing for sale and liquidation purposes, you need to tell the client the marketing period, how long the asset can be disposed, the period that you need to market it and dispose it. Is it going to be 6 months, 1 year or so? Particularly when you are doing large plans, you can go for a year or 2 years before the item is disposed. So you need to mention that as well. And even the method of disposal, you have to state it in the report, particularly if you are dealing with the sale and the liquidation purposes. You need to properly advise your clients. And another set of mistakes to do with the valuation date, right? The valuation date is missing in the report. There are certain valuation reports that you can sometimes come across in the practice. Maybe some of them, they are done by non-experienced valuers, but it's very important to take note of them. And even some of the experienced valuers, sometimes they forget to look into that. So we are reminding each other that the valuation date should be found in the report. In other cases, there are more than one valuation dates that you can find. Well, you have to state that. The valuation could have used a template report, like what I've said, the template report, and you are overwriting on an old report or on the template, and you failed to notice and change the old valuation date as well. So every time when you have finished doing your report, make sure that you check for that. And in some situations, it's not because of overwriting. Somebody forgot about it, or somebody did not bother to consider that, right? Did not consider to do that. But our expectation is that the valuation date should be determined based on the date of inspection, right? Or the valuation date can be provided by the act or a decree. If you are doing valuation for statutory requirements for a statutory organization, they provide, like courts, sometimes they provide you with the valuation date, or they say for litigation, they provide you with the valuation date. So you have to state. And sometimes your client can give you a valuation date as well. Or sometimes you can do historical, you can use a historical date which is specified depending on the client that you are dealing with. So that's how you can come up with the valuation date. Then assets valued were not clearly stated in the report. Assets valued were not clearly stated in the report. This also includes summary and location of the assets valued, right? It's very, very important to state. For example, if you I've seen some reports through my regular reviews that I used. I happen during my my years of practice, where you find in the report it is just stated air compressor and the year of manufacture, and then a value is given. And then we say, which compressor are you talking about? Right? Which compressor are you talking about? What is the capacity of the compressor? Right? So you need to state, is it an Ingersoll Rand compressor? Is it an Atlas Copco? Is it a fin air compressor? You need to mention it. We need to see the micro description, right? The micro description of the asset must be clearly stated. Is it an Ingersoll Rand? Is it a fin compressor? And what is the model? And all the details, the capacities and everything should be clearly stated in the report. Gone are the days where you just say an asset in air compressor 2022 and then you are done. The exact things must be provided. The summary and the location, when do we find it? Right? Is it in the compressor house? Is it in the factory? Is it in the backyard? Where exactly is the compressor? It's very, very important. So you must clearly state the macro descriptions, particularly when you are dealing with big plants. You have to state. You have to state the macro description. You have to give us the macro description in the report. The evaluation does not explicitly state the assumed interest or ownership status of the assets valued. Most evaluations skip this one. They don't show what is the interest behind that. What is the ownership status? You might end up valuing leased assets or borrowed assets, right? Rented assets. So it's very critical that you take note of that. Then there are errors identified by reviews associated with the use, selection, and application of the three common valuation approaches, right? The three common valuation approaches. I assume everybody knows them. So their use, did you properly use them? Did you select them? Did you apply them properly? It's very, very important. The report, some of the mistakes relating to this one is the report does not include consideration of all available approaches. In your report, in your evaluation, you need to consider all the market approach, the income approach, and the cost approach as well. You need to consider them. If you are not going to use, you need to specify. Just state why you are not using the cost approach, why you are not using the income approach, why are you adopting market approach. If you have adopted the cost approach, you have to mention why you have adopted the cost approach and its method. Market approach has got more than 3 approaches, right? Income approach has got 2 or more, same as the cost approach as well. So you need to tell us the methods. Why did you use one of the methods of market approach? Why did you use one of them? You have to mention, you have to state it in the report. What you are doing is you are being open, you are being transparent, and you are explaining your thoughts. You are explaining how you have done the evaluation to the client and intended user. So that is the requirement in terms of the IVS standards. The report does not include evaluation inputs such as the comparable sales evidence, asset lives, depreciation type, obsolescence, residual values, and other items. So it's silent, but you need to show them. They must be seen in the report. It's a serious mistake that should not be entertained. We must by all means necessary avoid and be clear and specify all the inputs that we have used. And the report does not clearly state the valuation analysis, adjustments, or specific assumptions. We have to show and you have to state how you have done it, how you have made your adjustments, if you have made adjustments, how you have analyzed your valuation inputs in order to come up with your valuation reports, results, and conclusions as well. You need to clearly explain and state that. When the market overview or market condition is not mentioned in the report as well, you need to give the market conditions. Give us a market overview of these kind of assets that we are dealing with. Particularly if we are dealing with banks. Banks, they want to know the movement of prices, how the prices are, how is the market of this kind of assets that you are valuing. So it's very, very important that you include that as well. So other considerations that you need to consider to put in, take into account are relating to one, mathematical errors evident in the report and the valuation schedules as well. For example, values in the report do not tally throughout the report. The total value is 23 million, but if you go inside on the summary given by the client, if you try to calculate all the values that are there, they will come up to 19 million. Yet in the summary, you are saying, in the total declaration, you are saying 23 million. Why? Because you did not properly calculate that. So you need to make sure that before you send it to a client, you need to mention that. I wouldn't want to be reminded by the client that, hey, excuse me, it looks like these are not adding up. Please make sure that you do the right thing. And the report contains figures without commas or reporting currents in the valuation summaries. Yes, for example, the report states 2 million like that, right? Just write 2 million. 2 million apples, 2 million laptops, 2 million what? Because we don't know what exactly you're talking about. So you need to properly state. Whereas the correct way of doing things is Saudi Riyals, 2 million, right? 2 million Naira, right? Nigerian Naira. So you have to state it clearly and look at how the commas, we need to show the commas in a proper way. So that, and on top of that, most of the time, you need to write in brackets the total amount in words as well. It's very important. If you say 2 million Saudi Riyals, and then you write it in brackets, right? And write it 2 million in words so that it becomes very clear and proper. The report does not provide external reference sources as well. You need to show us the sources where you have collected information, the source of your data that you have used, you have to mention it as well. And the most important thing as well is to show us the CV and the details of valuation team. I've seen instances where somebody has done valuation of an electrical utility, which is all over the country, and you find only a name of one person. You have to show the team that you have worked with, who did what during the valuation exercise. If you have used the 5 guys, some have done inspection and the collection of data, research, and all those things you need to mention, and their designation as well. So when we say a CV, this is not a job-seeking CV, but this is a technical CV. You are telling us what we have done in relation to machine equipment evaluation. Did you do courses? Do you have relevant experience to do with what you have done? Because That is openness, that is transparency, being transparent. You have to show that, and it's a requirement in terms of the IVS framework 50, that you have to show, you have to be skilled and knowledgeable about the machines that you are going to value. So that is the evidence that you are providing, that you are in compliance with IVS framework 50. Then we've got some consideration, because we are machine equipment valuers. So we've got important asset standards that we follow, which is the IVS 300, right? So the IVS 300 asset standards only apply to the valuation of plant, machinery, and equipment. Machine equipment valuers are expected to comply with the requirements of the IVS 300. So it's an expectation that you should comply. So I'm going to look at some of the mistakes that are common that we need to take note of, and try by all means to avoid them. And try by all means that you have taken measures to avoid such kind of mistakes. The first one is the report does not provide full technical specifications of the assets. We need to know the technical specifications of the asset, right? We want to know the macro descriptions, the micro descriptions of the assets that we are dealing with. If it is an oil refinery, tell us what are the inputs, what are the operating capacity, the design capacities. It's very important. On the macro side, you have to tell us the number of shifts. A lot of things that you need to mention. So please take note of that. And if it is even a motor vehicle, I've seen some of my clients giving me their asset list, and you say Mercedes-Benz trucks, right? I will not go and say Mercedes-Benz truck number 1, Mercedes-Benz truck number 2, because which truck are you talking about? Because there are some mechanical hose, they are rigid, they are tanker trucks, which are Mercedes-Benz. So you have to specify correctly. If we are dealing with a Mercedes-Benz 4343, right? 6x4 mechanical hose. So I'm being specific. You see, so all those technical specifications must be put in the report. Must be put in the report. Another thing is the report does not clearly state the remaining useful, economic, or effective lives of the assets. The report is not specifying it. It's not showing that. So we are required to show the remaining useful lives. You are supposed to show us the economic lives. You are supposed to show us the effective lives as well. That is very, very important. That is very, very critical. We have to tell us even the source of the economic lives. Where did you get your economic lives? You don't get them out of blues, but we have reference. Are you using the ASA life, the normal useful life tables? You have to state. Are you using, which source are you using? You have to specify that. And not to just use your own. If it is a manufacturer, if you are provided by manufacturer or by the agent or supplier, you have to state that you got them from the manufacturer or the supplier. Another mistake is the report does not clearly state the condition of the asset being valued, the condition of the asset being valued, including the maintenance history as well, right? So most of the reports, or some of the reports I might say, I don't want to offend people, but it's good to take note of that. It's good to take note of that. That the condition of the asset must be specified. It must be specified. Were they in good condition? Were they in fair condition? What exactly was it? We have to state that. We have to as well mention the maintenance cycle. The maintenance cycle, the maintenance history. Was there any refurbishment which was done? Was there any rebuild which was done? Was there any heavy maintenance which was done on the equipment as well? Sometimes with that information, we use it as well when we want to come up with effective age. When you want to come up with effective age, you have to consider that. Because there are certain machines, I've come across certain machines which are 40 years old, and their economic life is 25. But they are still running. What has been done on the machine so that they continue running? So if you look at the maintenance history, that's where you can see. And then you can come up with an effective age for that machine based on the condition. So it's very, very important. It's not just a thing that should be done in passing, but we should utilize that. You should learn, you should develop yourself to understand these kind of things. The existence of any physical deterioration, functional, technological obsolescence are not stated or justified at all, right? The report is silent. You know, there are certain reports that you see, you come across where they just state the value, they just state the name of the machine, not the condition, the name of the machine, the serial number, the model, and the value. And there's nothing mentioned about the physical deterioration. Was there any functional? Just mentioned. If there was no functional obsolescence or economic obsolescence, just state that. Right. Just state that and justify yourself. If there was a functional obsolescence, you have to mention the functional obsolescence is based on these items or these factors. Then you can state it properly and clearly, right? That is very important when it comes to the valuation. And then another mistake is the report does not consider the existence of any costs associated with the valuation of the subject asset. Any costs associated with the valuation of the subject. Costs, sometimes you have used the cost approach, right? You just mention the replacement cost new. And I've used the replacement cost new. How did you come up with the replacement cost new? There are direct and indirect costs that are used, that build up the replacement cost. How did you build up your replacement cost? It's very, very important as well, especially if you are using the in situ, the premise of in situ, that is the current location. Their installation, their commissioning, their add-ons, there are some things that we have done on the machine on its location. When you are in the premise of ex situ as well, not in the location, you are pulling it out, you are decommissioning it. All those costs of decommissioning, cost of dismantling and transporting and everything should be considered as well. So some of these values, they don't show that. Some of the reports, they don't explain how this has been, whether this has been considered or not. Then it comes back to the valuation, and it can affect the valuation as well. And another thing is the costs may include decommissioning, removal, installation, recommissioning, additional equipment, transport, installation, and commissioning. These are some of the things. The list is endless. There are lots of things that, depending on the asset that you are dealing with, if you are dealing with huge plants like oil refineries, power plants, all those ones, desalination plants, they've got a lot of costs that are considered as well. So you as a valuer, when you are doing your work, consider everything. It's good to revisit IVS 300 before you start embarking on a valuation project. The report does not consider the existence of any relevant environmental factors affecting the value of the subject asset, such as the location in relation to the raw material. You need to consider that as well. Where are they getting their raw materials? That is very important. It need to be considered the market for their products. Where are they going to sell? Are they exporting? Are they providing the entire Saudi Arabia? Are they providing the entire Nigeria? Or they are just dealing with the Lagos or Igbo state, or which state are they dealing with? You need to consider all those things as well. Suitability of the location. Is it the right location? Is it a suitable location? Because, you know, changes of regulations, they can affect the suitability of the location as well. There are certain plants which were built close to a location. I still remember where I grew up, there was Portland cement. It was very close to a location, to a residential area. So people were complaining of pollution. So these are some of the things that you need as well to consider. The suitability of the location as well. The impact of any environmental or other legislations that either restrict the utilization or imposes additional operation or decommissioning cost as well. So these are things that you need to consider. Is it applicable to your report? If they are applicable to your report, to your valuation exercise, they must be seen. If they are not, we must see which ones and which ones are applicable. So you need to state that. Because sometimes the valuer who is reviewing your report knows that there are environmental or legislation factors that might affect your valuation that you did not consider. So in that case, you have to revisit as well. So if they are auditors, they will request you, say, can you go back and organize yourself? So it's very important that you take note of that in the first instance. Licenses to operate certain machines in certain countries may be restricted. So you need to look at the licensing. Is your client operating within the requirements of the law, or is not operating with the requirements of the law? Or maybe the production or the use of those kind of machines has been banned. So there's no market for that. So you might give value to something that is almost not usable or something that you cannot sell. So you have to consider that as well. And then there are some mistakes as well. I'm still continuing on the IVS plant and equipment, IVS 300 plant and equipment. The report does not specify whether the asset is attached to or integrated with other assets. It is a very important, it's a very important requirement to consider the extent to which the subject asset is attached to other assets. This may impact on the asset value. You know, there are certain assets, they have got certain plans. Like if we look at the oil refinery, it requires boilers as well. It requires electricity as well. It requires water. Maybe they have got their own desalination plant or their water purification or a water treatment plant. So those are some of the things you need to see what is the relationship, right, with that. Because the presence of certain assets which are linked to your asset that you are valuing can impact on the either positively or negatively on the asset value as well. So you need to consider that as well. The report did not sufficiently outline the assets excluded from the valuation. Because if you go to any factory, most of the time, particularly if you are doing for financial, not for financial, for secured lending purposes, sometimes a bank can ask you to value a certain section of a plant because they have financed that section. So they are only attached to that thing, to that section. So what do you need to do? You need to specify that you are not valuing the entire plant, but you are valuing certain portions of the plant. So you have to show what has been excluded. Sometimes you can go to construction equipment as well. You can be asked to value graders only, but there are certain other assets that are around, right? In some situation, you might go to a client and they say, don't value laptops, don't value these assets, don't value compressors, don't value small items, just zero in on the production plant, not ancillary equipment, avoid ancillary equipment. So you have to state that. Real estate, you have to mention, we did not value real estate. So that should be mentioned. We did not value the warehouse, we did not value the factory. We have valued the compressor, but we did not value the compressor room. So those are things that need to be mentioned for your report to be very proper. In my closing, I would close once more with another quote, and this is very interesting. The quote reads, "To make no mistakes is not in the power of men, but from their errors and mistakes, the wise and good learn wisdom for the future." Right? I like this portion. The wise and good learn wisdom for the future. This is Platak who wrote this, and we need to learn from all these mistakes that we have seen that others have done in the past for us to produce reliable and credible reports. So that is very, very important. And my takeaways for the day is, one, the most important thing is you need to pursue training and professional development. This is very important for you to be a proper valuer, for you to be an experienced and a skilled valuer. You need to pursue training and professional development as well, like taking CPEs, like what we are doing, training on specific topics and skills. You know, we have in Saudi Arabia, we have got 401 up to 405, 5 courses that you do. So those courses are not enough for you to continue practicing in the industry, for you to practice in Saudi Arabia. I don't know about Nigeria. I know you have got courses that you do, some training that you do. That is not enough, but you need to develop continuously and take valuation in certain topics, valuation topics which are related to valuation, like report writing, right? Yes, we have done that, but you need to take it as a course where you need to go into the nitty-gritties of the valuation reporting, right? Yes, and then life cycle analysis and development is another course that you can take, which will help you to understand the life cycle analysis of machine equipment and how they are developed. Valuation for specific purposes. It can be like last time, 2 months ago, we did valuation for financial reporting, and we did another one, valuation for insurance. That will help us to equip and develop ourselves professionally and skillful as well. And then, excuse me, and then we've got valuation for specific asset categories as well. It could be valuation of aviation, valuation of marine, valuation of healthcare equipment, and a lot, agriculture, valuation of solar equipment. You need to take a course so that you become skilled, experienced, and be knowledgeable about those kind of things. And another point, advice that I'll give you as well in closing, be knowledgeable about and comply with the IVS and national valuation regulations. I hope most of us, or all of us, we have got a green book in Nigeria and IVS as well in Nigeria, in Saudi Arabia. I hope you have got the code of ethics as well and conduct in Nigeria and in Saudi Arabia as well. Don't have those documents. You need to read those documents, especially before you do an assignment. first of all, go through the standards and understand what they require you to do so that you comply with them. So you have to always refer to those standards and be absolutely committed to ethical principles and professional conduct as well. That is very important. If you are in Saudi Arabia, we have done that through the course 001, a regulatory framework for the valuation profession and international valuation standards. This is a course that you do during your first stages of taking our courses. But sometimes you need to revisit that, especially when there is a new IVS. Like next year, we are going to have a new IVS standards. So you need to take this course so that you are fully appraised yourself of the new development. Because the new IVS which is coming is totally different from the one that we are using. So you need to make sure you are always abreast of the developments that are happening in the industry. And then professionalism, I don't need to overemphasize this. This is very important. That is the thing that you need to reflect in your work. Professionalism, be fair, be objective, and the conflicts of interest must be saged, checked, and disclosed when they are available. It's very, very important, because when you are called to explain, that will not be good for you, for your reputation, and as well the reputation of the valuation profession as well. It needs to be safeguarded, right? And then transparency, openness, and confidentiality. That is very important. We deal with information that is very confidential, especially with listed companies on the stock market. We deal with them to do valuation for them. So you need to keep the information confidential, safely secured somewhere where no one can touch, no one can get access who is not a part of the team. And then trust and trustworthiness. Public trust is very important in our dealings as machine equipment valuer as well. Integrity, very important as well. And then the focus on clients. Our focus is on clients. Whatever we are doing, when we are doing valuation, we are paid to do the valuation. So we are paid to meet the expectation of the clients, not our expectations. Not our expectations, but the expectation of the client. And the client, of course, takes care of us in terms of fees. That is his, he focuses on us in terms of that. But we need to make sure that we meet the requirements of our client. That is very, very important. That's all I can say today before we move on to questions. Thank you very much. Now we can leave time to questions. If we have questions, Kelvin, you can assist me as well and in the reading of the questions.
Thank you very much. I don't know what to say again. It's a wonderful presentation. I have done presentations before. I know it's not easy to speak to people this way for over 1 hour, 30 minutes without having a break to take some water. Well, thank you, Mr. Ruka, for this presentation. Now, we take some questions from the chat. We have Rashid asking, what is the difference between industrial assets and property, plant, and equipment?
Right, industrial assets, that is the plants and equipment. It's another term, because an industry, it's a factory, or it's a kind of sector within an industry, like for example, an oil refinery. It's part of the oil and gas industry. So assets within the oil and gas industry, you'll find there is plants and there is machinery and there is equipment as well. So those are industrial assets. Property, we look at in terms of real estate. That is the building, brick and mortar, right? Those are things that we are talking about as property. That is real estate. So ourselves, we are not focused on real estate because real estate is attended to. Sometimes we call it land and buildings to mean property. That is real estate, it's land and buildings. That is done by another discipline. So our focus is on plant, equipment, and machinery. That's all.
Yeah, thank you. For Alami, in addition to what Ruka have just said, you have to be careful when you hear industrial assets too, so that they might be talking of general assets of the company itself, which goes towards when you're dealing with issues relating to business valuation. So you can see them categorize things like current and non-current assets, which will include cash and other items as assets of the company. So you have to be careful. We don't deal with usually, like you said, industrial assets generally. Here we're dealing with just plant and machinery and equipment of the company. So you have to be careful, especially when you are speaking to finance directors in the company you want to work for, so that you pick the language they are saying as finance people. So if I mention industrial assets, you might be saying something else different from what you have in mind. We have to be careful about that when we're doing just plant and equipment. There's another question. Someone was asking, what if the client does not want to state the financial institution or bank that we consummate this evaluation report? What do we do?
Sorry, can you come again? I didn't get the last part. Can you read it?
Someone was asking, what happens if your client does not want to state the name of the financial institution or bank that will consume this valuation report? What do you do?
Okay, if it doesn't, you just disclose in the report that the intended user is a financial institution and the client did not provide the name, right? Because what you are covering yourself against people coming back and say, excuse me, can you revise the report? Can you revise the report again? And can you put the name of the client, of the bank now? Right? Because what happens, some of these clients, they bring you evaluation, they want evaluation, and then they go around different banks using the same report. So now what the banks do is they want to make sure that they are secure. So what they do is they say, can you go and put the name on the report? So in other words, you are safeguarding yourself against the report being used by several users, and that they can come back against you, they can work against you. So the moment you write the name of the banker, if there is another banker who wants his name included, then you have to agree and make sure that things are properly ironed out with your client.
Sure, that's fine. You probably see us mention in reports, saying something like this report is intended for the use of the addressee, because you can't do a report anyway without addressing it to somebody.
Yes.
So if your client didn't tell you who the financial institution is, that means you're addressing the report to your client. Exactly. And mentioning in the report that is meant for use of this addressee, then you mean that you have qualified the report in terms of who uses it.
Yes, that's correct. It therefore means that the report, the intended user is the client as well. So you
Sure.
cannot use it for any other purposes.
Any other purpose,
You
yeah.
see, you cannot use it for any other purposes.
When you not
Because-
have need for any other purpose, he might need to refer to you back, come back to you
Exactly.
to now
They
to
need
now
your
disclose
permission.
to now disclose that he didn't want to disclose before.
Because when they mention a certain bank and say, like here we have got SNB, and they said, yeah, can you use it? Can you write SNB here? Now I need to make sure that I meet their requirements. So I will say, who is the customer relation person that you are working with, so that I fully understand their requirements. So it means I have to revise the entire report so that it meets the requirement of the banker. Because SNB and another bank that is in Saudi Arabia, they have different requirements depending on the plant that you are dealing with, right? So, because if you just write SNB, and then SNB, they come back asking you a lot of questions about that. So I don't think it's proper for me to be asked to revise the report over and over again. This is many working hours, which I'm losing. I have a lot of work to cover. So it's best to do everything properly at the first instance.
So, Mr. Gavin,
Someone is asking. Oh, okay, go ahead.
Yes, Basim.
Is Demola?
Okay, yeah, I just want to contribute something to this discourse. You know, in our case in Nigeria, for instance, the valuers can either get commissioned by the client, and the client in this regard is maybe the asset owner or the bank. So in the case where the bank has commissioned you to do evaluation for them for secured lending, then automatically I'm addressing my report to the person who engages me, which is the bank.
Yes, that's correct.
So if, for instance, Standard Bank has requested evaluation, a copy would be, the main report will be addressed to Standard Bank, and then a copy would also be given to the customer, that is the person seeking the fund. There are instances whereby the bank may not give the loan to the customer, for instance, for different factors, but because valuation is just a one out of many requirements. There are some other requirements that the client may not meet that would require the funds not being granted. So in that regard, the client can come back to the valuer and say, hey, valuer, I got a particular report from my bank that you did this valuation. The bank did not give me the fund. I'm going to HSB Bank this time around. Please assist me, address these reports. So in those situations, what should the valuer do? Do you understand the question now that Bank A requested for evaluation? I have done it, but did not give the person seeking the fund. So the person came to me and said, oh, this report was sent to me by my bank. You are the one that did it. I'm going to approach HSB Bank now. Help me readdress this report, redo it, and readdress in line with HSB's bank's standard. So in that regard, what do we do?
Yeah, you know, that is a situation I always want to avoid, because one, like what I said, the reporting requirements are different from these two institutions, right? If I have done the valuation for the first bank, Bank A, and I've discussed with them and they've given me their requirements, I've prepared the report, addressed it to them and gave it to them, right? So now the second bank, when they come to me, it's another assignment that I have to come back to look at the factors, look at the requirements, so that you properly address the thing, the assignment, and so that your valuation conclusions, they are correct and proper. So you have to revisit. Remember the time period between Bank A negotiations and Bank B. It might be 6 months or so, right? So there are things that can change in terms of the market of the assets. So the factors affecting the value at the time when I prepared valuation for Bank A, and now the period where I'm preparing valuation for Bank B might be different. So you have to take note of that. You have to take note of that. So it means it could be a second valuation assignment. If I'm going to revise, I have to prepare another scope of work and give you a fee so that I can properly do the valuation. Maybe the valuation date is going to change as well. When you are doing it, it's not a matter, Mr. Admola, where you just go and change the valuation date, or you are going to change the signing date, the effective date. No ways. If you do that, the bank, whatever happens, they will come against you. You are working against yourself, and we are going to disgrace yourself in terms of your professionalism as well. So do the right thing. If the bank, if he comes back and say, oh, bank A have refused, I need you to change the name of the intended user. You have to make sure that are the conditions still the same or they've changed. If there is a longer period that warranties that the conditions of the market has changed, so you need to come up with another proposal. You need to speak to the bank B and get their requirements, their expectations to do with the report, so that I do the report once and for all. The problem is when you just change the name of the bank on the old report, and then the bank calls you and say, can you explain, can you add this, can you add this? Those are your working hours that you are going to do. Are you going to do it for free? That is the situation.
There's another question from Mr. Defila, who I think is related to what we're just answering. He was asking, is it not possible to prepare a valuation report for insurance purpose for a client, after which the client then decide on which insurance company he tends to use the report for? How then would the valuer discuss with the insurance company ahead of the evaluation report?
Right. Yeah. This is where the level, that's where we say a valuer should always be ahead of things, ahead of situations. To be honest, insurance valuation is specific to a certain insurance policy. All insurance policies are not the same. Company A is an oil refinery, is in oil and gas industry, and company B is in oil refinery, in oil and gas industry as well. They have the same assets, but they are going to use two different insurance companies. Their premiums, their terms and conditions are going to be different depending on the company. So there is no evaluation which is specific to all. A size fit all type of valuation in terms of insurance, it doesn't work. Get to know, get the insurance policy. What are the terms and conditions first? So don't do evaluation for insurance blindly without knowing the terms and conditions of the insurance. What is the duration of the insurance? Is it for 2 years? Is it for 5 years? Is it for done annually? Right? Those are terms that you need to understand. So it's not a matter of just, oh, you want insurance valuation? Okay, I'll give you after 3 days. I'm coming to do inspection, and after 3 days, your report is done. Without knowing the insurance policy, that is very inappropriate and unprofessional.
Someone is asking, do we need to round up figures? Say maybe 2 million naira, or you have to add the next, say 2 million naira, 25 kobo, 55 naira, 20 kobo. What do we do when we have reports like that?
Okay, thank you very much. It's an interesting question. You know, you have to define our figures, right? The final figures, you have to round them off every time, right? When you come up with a market value for a machine, you have to round it off, not to the last kobo or to the last, yeah. You don't need to do that, right? to the last halala. I wanted to say halala here in Saudi Arabia.
Okay.
You don't need to do that. What you need to do is you need to round off the market value, not the calculations in between, but the last value, the market value, you need to round off. You can round it off to 100, to 1,000, to 10, depending on the value, right? If we are dealing with billions, you can't get to the last naira or to the last kobo, no, or to the last real or to the last halala, no. You have to round it off reasonably, right? You have to round it off reasonable. Rounding off is very important. It's acceptable. But you have to do on the final market values or final opinion of values.
Yeah. Really, that means what you're saying is you have to follow the pricing model in the market where you are dealing with.
Yes.
So the product you're valuing, the asset you're valuing, the way they sell it, round up to the nearest figure they use in the marketplace where your valuation is covering, you have to apply it that way. Now somebody is asking if you're valuing asset more than 1,000 in number, how do you deal with comparable sales for each of the items? Do you need to now explain it, do the comparable for each of them in your report, or do a general comparable?
Right. You know, one thing that I need to advise my fellow valuers is valuation. It's not like what I can say. It's not like a programmable thing. We are trained to use our own judgment, our own discretion, right? And justify why you have done that. There's no a rule. It's not a rule that you should use comparable sales. You should use, when you are dealing with this, you should use cost approach. It depends with the information that you have. If these are 1,000 assets, I don't know. Are they the same assets? Or are they assets, different assets? And how many groups of assets are they? As you can see, it's not clear, right? It's not clear whether these assets are all bulldozers, right? If they are all bulldozers, D8, if they are 1,000 D8, then you just do your mathematics and your adjustments, right? But now if you have dozers, graders, forklifts, front-end loaders, and a lot of compressors, this, you know, you know how to deal with that, right? You know how to deal with that. So it's not a matter of saying I'm using comparisons and the assets are more than 1,000. How do you deal? How are you going to deal with that? And remember, you have to analyze each and every asset or a group of assets. Your approach depends on the information that you have. So we cannot say do it like this, but what we say, take into account of the information that you have, the type of assets that you are dealing with, the categories of assets that you are dealing with, so that you can see the approach. How do you approach that?
Okay, it's important to mention that we have some questions in Arabic. Maybe at a point somebody will help us pick some of those questions.
Basim is going, I think, if we are done with English, we can allow Basim to explain.
We're not done with English. Somebody is asking something interesting. How do you valuers ascertain what is useful, remaining useful life of an asset when you're doing valuation?
Can you come back again?
Is asking for, while carrying out valuation of plant and equipment, how do you ascertain remaining useful life of the asset you're valuing? The economic or effective lifespan of the asset. How do you ascertain?
How do you come up with Taqeem? Right, Taqeem, we normally base on the ASA, normal useful life tables. This is one of our sources, and like what I said, there are certain sources of machine equipment, depending on what you are dealing with. You can be provided by manufacturers, you can be provided by suppliers, you can be provided the economic lives by agents as well. So those are the ones that you deal with. And coming up with the economic lives, this is the sources or where we use the economic lives. And then age, it's something that you can easily calculate. Anyone who is a plant and machinery can come up with the age of an asset. And if you have economic life minus age, you come up with the remaining useful life. So this one is a simple mathematics that you can deal with, because economic life is effective age plus remaining useful life. So if you want remaining useful life, you just do the mathematics and come up with the remaining useful life as the subject of the formula, right? So that's how you can deal with that. So we have sources that there are a lot of sources that you can deal depending on the type of asset that you are dealing with.
So someone is asking, when using cost approach, which life do you use? The economic life or physical life of the asset?
Economic.
You say, what's the difference between the two, the economic life and the physical life?
Economic life and the physical life. Physical life and economic life. I think you can see already economic life. This is the economic life. That is the period of time that the machine is put to use, right? That is the period the asset is expected to be put into use, economic use. And then after that years, the asset will be sort of like no longer useful or giving any economic benefit to the user. And then the physical life, that is the period that the machine has been in use, right? The physical age, we can call it sometimes as physical age. Sometimes we can call it a chronological age. That is the difference. So there are two different things that we are dealing with.
Okay. See, unrelated, someone was asking, is remaining useful life reported? The remaining economic life or remaining physical life or remaining design life? Please, may you explain your view of this in financial reporting?
Right. You know, people like playing with words, but they are talking one thing. So I will state the remaining useful life. That is the one I use mostly, right? The remaining useful life. Yeah, you can report that, especially when you are dealing with financial reporting. You know, the remaining useful life is very important when you are providing fair values, because your client is going to do depreciation, right? Do depreciation over the remaining life of the asset. So if they know the remaining useful life, they'll use it for depreciation. So it's very important to provide that. It's very important to provide that. You give your remaining useful life and the fair values as well to the client so that he can make use of that. So it's acceptable. It's an expectation.
I don't know. Someone is asking the difference between valuation and appraisal.
It's one and the same thing. If you are in the US, you talk of appraisal. If you are here in Nigeria and Saudi Arabia, you talk of valuation.
Someone is asking, how do you value plant and equipment that are meant for litigation purposes?
No, that one, how do you value? Yeah, our webinar was centered on looking at mistakes and errors, right? Like what I've advised is take a course or a webinar on valuation for litigation purposes so that you can fully understand. If I try to explain, I need another 1 hour, 30 minutes to explain properly how to do valuation for litigation. That could be, I hope Alanud is taking note of that maybe it could be one of the webinars in the next season that we are entering. It could be one of the, yeah.
And
okay,
that would be very
Tunji.
interesting. As a lot of lawyers and people, some clients, it's going to be very interesting if we do have that. Lawyers, government agencies, everyone would want to come in to participate in that.
Okay,
Tunji.
okay. That's fine. We'll take note of that one as well. And
Tunji is asking, how do you treat impairment in plant and machinery equipment valuation?
Yes, I think if this guy was in the last webinar, which we did, he could have been helped by that.
Yeah.
Right? He could have been helped by that. But if you want a quick one, I think is it this month or next month? ASA is offering a similar a course which deals with impairment. You can go on ASA website and get registered for that course. Here we can't explain it in full. We need more time to, it's a subject on its own as well. That needs more time to fully understand and show you the requirements, the expectations, the approaches, and how do you deal with that one.
But the most important thing for him to note is that impairment, we are talking of loss in value of asset from the original carrying cost. So once the finance people dictate there's an impairment, they call your attention to tell you that you have another job to do. Anyway, there's another question, but I can't get it. Somebody was asking something about, do you do valuation based on mass reinforced concrete separately from the plant? Maybe is he talking about doing the valuation for the installation separate from the plant?
Right. That reinforce the concrete, right?
Yeah.
For example, especially when you are dealing with let me give you an example of a cement block manufacturing plant. When you are putting it up, that brick molding plant, that machine, the brick molder, right? That machine, it vibrates. So it needs a strong foundation. So you have to put that foundation and reinforce the concrete. So it's part of installation cost. So you need to consider that in building up your replacement cost new. The price of the machine, the cost of the installation should be taken into account for you to come up with a proper replacement cost. Yes, it is considered, it is added as well. So you need to work out that.
Maybe he's referring to, you mentioned to them about in situ and ex situ. So one need to know which one is your valuation covering. Is it in situ or ex situ?
Okay. Right. Yeah, remember when you are removing the machine, you don't remove the concrete. You just remove the machine. So it's part of decommissioning and it's part of the dismantling costs. So it becomes the cost. So ex situ value is less than the market value in situ. More, that's what happened. Yes, it's because of that you don't take into account of all those concretes.
So I think we can take the questions in Arabic now.
Okay, that's fine. Thank you. Basim, can you please help us with the
question?
Yes, Arabic translation.
Arabic.
Sorry, let me exit this because I can't hear the Arabic. Yes. Or the best method and approach, it depends within all methods and approaches can apply depending on the information. There's nothing we can prescribe. We can't prescribe to you. the approach and the method that you can use. The approach and method that we can use, that we can use. Nobody, no textbook, even the valuation standards, they will never prescribe to you the approach that you can use to value airport equipment and buildings and everything. It depends with the information that you have. So my advice is look at the information around you and say, can I use market approach? Can I use income approach, or can I use cost approach? Right? Depending which method of cost approach am I going to use, depending on the information provided. One airport, you can use cost approach, it can work for you. Another airport, because of information that you can use income approach. And another airport that you can do as well, you can use market approach using percentage of cost, or you can use a direct match. It depends with the equipment, with the information that you are dealing with. So evaluate, that is your own judgment. That is where the skill and experience of evaluator should be seen. That's where we say, yes, this is an experienced evaluator. The way you have approached, the way you have seen, you have sit down and looked at your information and say, okay, this is the information that I have. So I'm going to use this method which is applicable here. So we cannot detect for you. Over to you, Basim. Right, that one, I think it's outside our the scope of this webinar, but our advice is if you go into the Saudi Machinery and Equipment Evaluation Manual, you can find that being explained properly, how to do the valuation of scrap. And if you have been as well attending Taqiim machine equipment courses, I think it has been dealt in most of the modules there as well. So we can't explain to you properly. We need more time, as we are running out of time. Right now, Alanud wants to stop us. So my advice is to make reference onto that, or you can contact us direct at Taqiim. We can provide, particularly if you're a member, you know how to do it. We've got our ticket system. Send your question on the ticket system, then we can provide you information on that. Okay, that's fine. Thank you very much.